Ever wonder why gold prices seem to dance up and down like they're playing a game you can't quite figure out? You're watching charts, trying to time that perfect trade, but one day it's soaring, and the next it's crashing, leaving you dizzy and second-guessing everything. Today, we're cracking open gold trading, and I'm gonna make it super easy to get by using something as simple as a pair of dice. Yup, dice. Think of the gold market like a casino game. It's got its ups, downs, and those heart-pounding moments where one move can make or break you. But gold trading isn't about throwing money at random bets. It's about spotting patterns, playing smart, and riding those shiny waves for profit. By the end, you'll know how to trade gold without losing sleep or chasing every price spike. Let's dive in. Gold trading can feel like a maze if you're new. Maybe you've tried jumping into stocks or crypto, but gold has got this old-school vibe, like something your grandpa would stash under his mattress. Problem is, it's not just buy low, sell high. Gold moves for weird reasons: inflation fears, dollar strength, global drama. And if you don't know what's driving it, you're just guessing. Day trading gold is a nightmare. You're glued to your phone, watching every tick, and one bad move wipes out your gains. Long-term holding? Sure, but waiting years for a payoff isn't everyone's jam. That's where swing trading gold comes in, catching those sweet price swings over days or weeks without the stress of staring at screens all day. Here's the deal: gold isn't as random as it looks. It's got rhythms like waves in the ocean. Prices climb when people panic about the economy, think wars or bank failures, and dip when things calm down. Swing trading is about catching those waves, not fighting the tide. And that's where our dice come in handy. Imagine gold prices as a pair of dice rolling every day. Some days you roll low price drops, maybe 1% or 2%. Other days, high rolls, price jumps. Your job? Wait for a streak of high rolls to jump in and ride the wave up, then hop off before it crashes. Let's break it down with an example. Picture gold at $2,000 an ounce. Last week, it dipped to $1,950 after a strong jobs report made the dollar look beefy. That's like rolling a 3 or 4 on our dice. But then some global tension hits the news, and gold starts climbing. $1,960, $1,970, $1,980. That's 3 high rolls, 8, 9, 10 signaling momentum. You buy in at $1,980, aiming for $2,020, a 2% gain over the next few days. But here's the key. You set a stop loss at $1,965, risking only 0.75%. If the dice turn cold, say a 2 or 3, you're out, losing just a bit. If they keep rolling hot, you cash out at $2,020, banking a tidy profit. Now let's walk through how to spot these setups. First, check the daily chart for gold. Use something like XAU/USD on a trading app. Look for a pullback, like 3 to 5% down from a recent high, followed by a bounce. That's your low roll turning into a high one. Tools like the 20-day moving average can help. If gold drops to it but doesn't break, that's a signal to watch. Also, keep an eye on volume. Big buying volume on an up day. That's your dice rolling a 10. News matters too. Check for stuff like Fed rate hikes or geopolitical flare-ups. They're like shaking the dice cup before a big roll. My first gold trade was a wake-up call. Back in 2023, gold was wobbling around $1,900 after a Fed announcement. I saw it dip to $1,880, then bounce hard on news of some Middle East tension. Dice went from 4 to 9. I bought at $1,890, stop at $1,870, targeting $1,930. Over 5 days, it climbed steadily. $1,900, $1,910, $1,925. Sold at $1,928, up 2%. Felt like nailing a perfect roll, but it wasn't luck. It was the setup. The chart, the news, the volume all lined up like a good dice streak. But gold can trick you. The challenge? It's sensitive to stuff like the US dollar or interest rates. Say you buy on a good setup, but then a surprise Fed rate cut drops the dollar and gold spikes too fast. You're tempted to hold forever, thinking it'll hit the moon. Don't. Stick to your target, that's your dice rule. Or worse, a random tweet from a politician calms markets and gold tanks. That's why you need a stop loss. Risk only 1% of your account per trade. Got $10,000? Max loss is $100. That way, even a few bad rolls won't sink you. Let's simulate a trade to make this crystal clear. Gold's at $2,050. It drops to $2,000 on dollar strength dice rolling 3s and 4s. Then, inflation data comes out higher than expected. Gold jumps to $2,020, then $2,030. High rolls, 9, 10. You buy at $2,035, stop at $2,015, 1% risk, target $2,070, 1.7% gain. Over 4 days, it moves $2,040, $2,055, $2,065. Day 5, it hits $2,070. You sell, pocketing $35 per ounce. If you traded 1 ounce, that's $35 minus a small fee. Scale it up, and those swings add up fast. The big moment for me was last year during a crazy market dip. Gold was at $1,950, then crashed to $1,900 on some banking scare. But the chart showed a double bottom dice hitting 3 twice, then bouncing to 7. I bought at $1,910, stop at $1,890, target $1,960. Over 10 days, it grinded up $1,920, $1,930, dipped to $1,925, then $1,945, $1,958. Sold at $1,957, up 2.4%. That trade turned $5,000 into $5,120, but more than that, it showed me gold swings are predictable if you watch the dice charts, news, and discipline. So here's the bottom line: gold trading with a dice mindset is about 3 things. Spotting the wave, capping your risk, and sticking to your plan. You don't need to be a genius or watch markets all day. Just learn to read the rolls. Charts for patterns, news for triggers, and stops to stay safe. Gold's always moving: inflation, wars, dollar shifts. And swing trading lets you catch those moves without the chaos of day trading or the weight of long-term holds. For help and recommendation, please check the video description below.